Good afternoon, everyone. I'm Mike Morris. I'm a partner with Wipfli. We're a national accounting firm. Thank you for joining us today. Our panel discussion today is around three trends shaping the regulatory landscape for financial services. I'm joined today by our panelists, Brad Rustin. He's a partner with Nelson Mullins. We also have Nathan Ottinger, a senior vice president with Atlantic Capital Bank. And finally, we have Scott Talbott. He's the senior vice president of government affairs for the Electronic Transactions Association. If you have any questions today, we appreciate you putting them into Slido, and we'll take them as we get them. We'll save a little time at the end to wrap those questions up as well. First, we want to talk about the OCC Special Purpose National Bank Charter. We're starting to see some movement in 2020, and we want to talk a little bit about what that looks like and what we expect to see today. So I think, Brad, would you like to start with that one?
Yeah, thanks so much, Mike. And, it's really interesting the trends we're seeing macro within the space where there's been a real back and forth between state and federal regulators. And we've had the promise of this OCC Special Purpose National Bank Charter now going back to July of 2018 when the OCC first announced that it was becoming available. And we had some initial enthusiasm surrounding it. Then you saw the series of lawsuits both in New York and in DC that have tended to cloud some of the special purpose national bank charter progress that was being made. It's interesting. What we're seeing now is a lot of folks who are going to a full purpose charter, really shifting things over and going to a full service bank in order to push through those OCC charters right now, while things continue to kind of work their way through regarding the special purpose charter and whether or not that actually is going to materialize at some point, particularly in the payment space. And, as we think about 2020, 2021, particularly in light of potential impact that the election may have, there really is potentially a game-changing shift as we see some of that back and forth. Depending on what happens at the national level, you may see a shift at the federal regulatory or at the federal regulators, and you may see more shifting back towards state-based models. And so it's a really interesting dynamic that's going on with the Conference of State Bank Supervisors trying to push back, really trying to garner footholds to try to draw people back into state-based money transmission licenses or state-based lending. Then you have the federal regulators, OCC, with former comptrollers as well as the current comptroller making statements trying to encourage cryptocurrency at national banks, really trying to push some of these national charters. And I think it's really interesting in terms of dynamic as we see that push and pull at the state and federal level, and perhaps most recently the banks coming out and actually coming out against some of the special purpose charters that were being considered. So you've got a lot of interesting political forces at play as we close out 2020 that's really changing that dynamic.
Great. And Nathan, from your perspective, being a banker, what are your thoughts on the OCC charter, the special purpose charter?
Yeah, we struggle with this a little bit, and I would tell you most of the clients that we are chatting with are tending more towards a kind of bank partnership model than going for a special use charter. So I think our perspective is going to be more in that realm. But at the end of the day, you've got regulatory authorities that are looking in on these businesses. And those regulatory authorities are going to be focused on consumer protections. They're going to be focused in on safety and soundness. They're going to be focused in on payment systems risk. And whether that is through a bank partnership model that the Fintech has to comply with, or through a direct banking charter kind of model, those are the things that the Fintechs are going to need to prepare for. And that's where we spend most of our time thinking and advising our clients is around that type of activity.
And Scott, what's the ETA's take on these special purpose charters?
Sure. So real quickly, as way of background, ETA, Electronic Transactions Association, we represent sort of the traditional and the cutting edge, both the banks and the fintechs. So we bring together both groups. In general, we see a convergence between the two, banks working with fintechs and vice versa to move products and services forward. When it comes to Payments 1.0, Payments 2.0 charter, our member companies are generally in favor of the concept. They have some concerns. I think Nathan just touched on them, in that if a fintech entity enters the space or has a charter, how will it be regulated? And our view is, and I think Nathan started to go down this path, is that the you can't not regulate them. You have to regulate them. A lot of the fintechs already are regulated, especially at the state level. But the regulation should be tailored to the risk profile of the entity. So banks aren't all regulated the same. You've got GSIBs, you've got capital, you've got leverage. Same concept for a fintech. If it's a small fintech player that's doing low volume, low risk, the regulations should be X. Take it to the other extreme. If it's high volume, higher risk, then the regulations should be tailored. So no one's arguing they should be regulated, but should be tailored, as I said, to the risk profile of the applicant. However, when you get into the second part of the fintech charter, when you talk about 2.0, which is direct access to the things get a little more murky in terms of what would that regulation look like. Should fintechs have access to the Federal Reserve? It opens up a different category of risk, payments risk, systemic risk. What would that look like? And that's a little bit tougher question to answer. But in general, our members are in favor of creating a new charter as long as the regulation is there.
Great.
And Mike,
And when we talk, go ahead.
Well, I was going to say, I think Nathan made a good point, which is a lot of fintechs come to us and they're struggling with that very question, which is, should we pursue a partnership with a bank, or is there really an advantage of going through the process of either exploring a state charter like an industrial loan charter and then seeking FDIC insurance on the back end? Or is it better simply to work with an established bank or financial institution or even an established money services business in order to build a platform? And I think that's one of the interesting points Nathan brought up, which is when you start to balance what the relative costs and expenses are, you have very similar regulatory costs. I mean, whether you're working with a bank or whether you're working, to develop your own bank, you're going to have a fairly complex regulatory infrastructure, whether you're on the payment side or the lending side. And then similarly, if you're going to go and start your own bank, not only do you have those compliance risks, you don't have a bank to rely upon. And on top of that, you're going to have capitalization requirements. I mean, if we look at the charters that have gone through so far and been approved, it's anywhere from, say, 55 million in capital all the way into the low hundreds, averaging somewhere in the high double digits in terms of millions of dollars in paid in capital that have been committed to the charter process. And so, for a fintech that may be exploring these choices or trying to decide what path to go down, you're balancing this concept of this concept of a future special purpose national bank charter, an OCC full banking charter, similar to what Vero did, where they're going to deal with all of the regulatory regime associated with having a national bank. Or looking at similar to what Square and others have done, where they went and got an industrial charter from a state and then looking to get FDIC insurance tagged on the back end. And all of those have, kind of the risks and rewards. And I thought Nathan was making a really good point, which is, especially for some fintechs, there's a third rail as well, which is partner up with a bank and really work to build that collaboration. It sounds like Scott as well has been doing some of that work on the payment side.
Yeah, and I would just add on to Brad's point there that even if you just partner with a bank, the OCC's third-party guidance means a lot of the regulations the bank is subject to flow down to the fintech so that you aren't, or it is not, the weak link in the chain. So no matter where you are in the space, you're going to have regulations. The key in our view is, how do you create a positive policy environment to encourage the continued development and deployment of new products and services to allow banks and fintechs to work towards the common goal of serving the customers and advancing the economy. So.
Yeah, I think Brad brought up a really interesting piece too on kind of the capitalization side. And I've spent most of my career in banking and are used to kind of having banks having to raise large amounts of capital. Fintech companies many times are not of that mindset, right? They raise capital to build product. They raise capital to deploy that product to market, and then adding on a capitalization requirement on top of all of that other kind of capital required just to put product into market is a really interesting kind of thought experiment that needs to be done. And I know Brad and kind of his team have expertise kind of facilitating those discussions. So it is just a very different environment when you're thinking about, do I capitalize as a bank and a bank holding company, or do I capitalize as a fintech company who wants to deploy product? And those decisions need to be made pretty early on as the company looks to scale.
And I think, Nathan, you make a really good point there too, which is, in September, the Conference of State Bank Supervisors really upped the ante, where they came out and, if you're for instance, a payment company in more than 40 states, one company, one exam. And that was the real advantage of the bank charter, is we could go 49 different states for payment processing instead of having 49 money transmitter licenses, or getting 50 states plus overseas territories for lending licenses. And if the CSBS and the state regulators are able to unify that exam and regulatory structure, that also plays in the equation about what is the true advantage of that charter. Whereas the charter, whether it's through partnership or your own, is the ability to run one product, one payment engine, one loan product across the entire United States. And that really is the magic sauce right now the charter gives you.
Agreed. That's a very attractive feature considering the cost, both in terms of time, dollars, and other resources that have to be committed to get all those state licenses. The one-stop shopping, and to some extent the regulations, although it's not pure one regulator, but that's the definite appeal of the payments charter, especially the 1.0.
And what about some of the fintechs that are looking to go a different route and purchase a bank to get that charter?
It's an interesting conundrum. What we found is right now it's awfully hard to buy a charter. I mean, going back almost 7 years, we were helping a payments company that was looking to pick up a struggling national bank. And we were, when inflatable charters were really the hot thing in the wake of the last recession. You pick up a small struggling state or national bank, you'd capitalize them back up, seek regulatory approval for a change in business plan, and then pump the thing up into a giant payment bank or a lending bank. The number of just dead charters floating around is not high right now, so that serves as a challenge. Second, even if you can find a charter that's floating out there, the question is, do you really want it? And is it the right fit? I mean, we saw maybe 2 weeks ago some of the fallout from some of the smaller banks or were two branch banks that became massive players in the payment space, entering into consent orders because of BSA AML issues or other regulatory struggles that they were forced to deal with. And so the inflatable charter is still very appealing, but it's fairly hard, I think, and certainly defer to Scott and Nathan, who may have more thoughts on this. But it's hard right now to find an orphan bank that's looking for new ownership where you could take that charter, convert it over, and all of a sudden run it up into a giant payments bank or a giant lending bank.
Yeah, I think what Lending Club did with Radius Bank is interesting, and I think that is a potential thing to keep an eye on, right? And cross current in this market. I can't remember how much I paid. I think it was sub 200 million for that acquisition. But is traditional M&A of fintechs, of banks, a trend? And it's one we kind of keep an eye on. And the challenge is, can you quickly get to scale with the products and services that you have to deploy through that bank you're acquiring? Because many of the banks weren't created specifically for fintech companies, right? They might have a ag lending business and a consumer finance business, and how do you kind of marry those up with a product set that's already out in the marketplace? So I think it's an interesting trend. Banks in this economic environment are certainly depressed from a price to book value, so that may happen more given where stock valuations are. But I think it's something to keep an eye on for sure.
Yeah, and then just to add on, the other challenge would be is if the fintech engaged in sort of non-financial businesses. Now we're getting into sort of the Walmart, Amazon discussion, but if they may have to shed those businesses or divest themselves under the current rules. Not many fintechs out there that would fit that bill, but that's another consideration as part of this analysis.
And Scott, I think you make a good point, especially for some of the legacy state money transmitters or state licensed lenders. That's a big concern with restrictions on the Bank Holding Company Act is, are you actually able to become a holding company? Are you willing to engage in those types of restrictions as well as the support obligations of a BHC if you actually go out and grab that charter? I mean, it's a fairly complicated issue that you've got to work through if you have an existing infrastructure, existing ecosystem surrounding your various businesses.
Well, great. I think that segues into our next topic, which is around vendor management. And I know with a lot of what the clients that I work with, the issue is sometimes they want to partner with a bank or work directly with the bank and be a service provider for the bank. And they don't necessarily speak bank or understand some of the regulatory scrutiny they're going to have. No different than if you get the special purpose charter, there's going to be a lot of compliance related issues you're going to have to deal with that you weren't used to before. And that cost of compliance can get pretty heavy. So I think, Nathan, this kind of throws it up to you, being the banker, kind of talking about the pains that the banks have to go through with the cost of regulation and the fintechs that you work directly with, the things that they need to be aware of so that you guys can partner together well.
Yeah, and I think appreciate you kind of flagging up this item, and Mike, you and the Wipfli team doing a great job advising clients and advising banks kind of on this complex regulatory environment. But I think this is certainly a trend, and I'm not a bank regulator, but I know when they come into Atlantic Capital Bank and evaluate our activities, the importance of KYC and the importance of BSA AML are always at the top of the list. And so when we are approached by a fintech company as it relates to potential partnership activities, whether that's ACH or whether that is BIN sponsorship or whether that's kind of FBO account structures, the first place we start is around compliance, because that is our bar, and we need to make sure our clients can meet the regulatory scrutiny as if Atlantic Capital Bank were onboarding their direct client. So that is the hurdle, that is the bar that we have to be able to document and stand in front of our regulators with. And so things like well-documented KYC policies and tools, extremely important. Things like AML policies that are reviewed and well understood, very important. Having a compliance officer within your organization, also important. Things like complaint policies and training programs for employees. Those are those kind of hurdle items that we see as important to being able to launch a successful fintech partnership with our bank and maintain the regulatory scrutiny that we are going to have as an organization. So there's a whole litany of things. The FDIC has a really interesting, a great white paper kind of on this. If there's any fintech folks looking for guidance on kind of third-party risk management and fintech relationships, I'd say definitely take a look at that as an interesting checklist as you're going through and building out your product set, if it includes money movement through a bank.
And that's not the end of it, right, Nathan? That's just the onboarding, and then following that, successful marriage begins the long marriage of oversight and continuous oversight. As the regulators look at it, the bank is protecting itself or fulfilling its obligations. So it's a long-term marriage, right?
Yeah, and very kind of timely point, because you look at some of the OCC regulatory guidance recently. It's been very much around ongoing management and ongoing know your customer and ongoing AML compliance. So absolutely, that is but the start of the marriage.
Right, and then throw in Bitcoin or cryptocurrencies or distributed ledgers, and now we've just upped the ante in terms of the complexity, both in understanding the product and the service, as well as regulation. Add in AI, and those just takes it to the super varsity level of knowledge and necessary resources to make sure you understand what's going on. And that applies to the regulators too, as they work through the new developments. They need to understand them as well. So.
And Scott, you make a really good point there, because we've been really impressed with the sophistication of the FDIC and OCC recently. They've really been upping their game in terms of sophistication on non-traditional payments or lending structures, and the caliber of the regulators is going up dramatically in response to this. And with that comes more knowledge about what it is that the fintechs are doing, the banks may be doing, and it's a challenge, especially as we talk to new fintechs, is, at some point you've got to rip this Band-Aid off. And that is, you might need a couple hundred page compliance management system. And we're either going to do it now or we're going to do it later. And one, we put into the bank, they approve it in a couple weeks after their folks get comfortable with it. They see that it's running and operating, or we go in and we have to build that over time. And, if you're a fintech looking to partner with a bank, being able to do that ahead of time, I think has a whole advantage to you. And Nathan, certainly would love your thoughts on that.
Yeah, I certainly think from a regulatory authority kind of viewpoint, I think there is fear a shadow banking system is developing, right? And their reach is going to be to the banks. It's not going to be to the fintech company. So, the banks are going to be guardians of the gate around payment systems and payment system risk, and making sure that those policies and procedures are there and administered and followed is our requirement, and one that we take very seriously. And when you see lending models, when you see depository models, when you see payment system models, well, that is the definition of a bank. And so the scrutiny is going to flow from the bank down to the entity that is kind of managing that ongoing customer relationship. So I would say that is highly important, and I would say of increasing importance as a trend for this space.
Nathan, you make a good point there, which I think there's going to be also more and more focus on lending. I mean, we've seen the Colorado settlement that's given us a little bit of a path forward on the lending side. So much of the focus has been on the payment side, but also on the bank model lending relationships. I think as the states try to pull back and really regain some of that control over interest rates, product offerings, what have you, I think you're going to see more and more states really trying to flex their muscles. Even as the OCC tacks further and further towards valid when made, some of the other concepts to protect the bank fintech lending models, I think that the states equally are going to become tacking harder and harder against the fintechs, where you need to be planning early on these structures, understanding what's permitted in the various states, because you really could get yourself into trouble if your model relies upon certain features.
Yeah. And I think, sorry, go ahead, Scott.
Please. No, please.
I think that's especially important now when you have a challenging economic time and you're going through a credit cycle. Those are going to be enhanced scrutiny, and we think the regulators are going to be on that activity and reviewing that activity in a much more strenuous environment given this economic cycle.
I think I was going to echo both Brad and Nathan's comments there. We've already seen California beef up its regulatory oversight. We have the Madden decision up in the Second Circuit. We're seeing a lot more scrutiny from right now at the states over lending, over consumer finance, and this talk about it later. But if the Democrats take the White House as well as the Senate, or either one of those, we'll see increased scrutiny over financial institutions, payments, and more of a tilt towards consumer protection. So.
And I think the earlier
Nate, go ahead.
Oh, okay, thanks, Mike. And I think the earlier a fintech can start working with people knowledgeable, find that bank you're looking to partner with or meet with a number of banks, really understand that climate. And the sooner you can get comfortable with how your model is going to function, I think it really is better for the fintech. Oftentimes we see someone who has matured a model, has gone out to investors, and then we're restructuring the underlying legal mechanisms in order to comply with either a bank's third-party vendor management policy or to comply with state risk restrictions, what have you, if it's a lending model or what have you. And the sooner you can work with good advisors or good bankers to help you understand that obligation, the cleaner it is for your investors. I think the better you are received in the marketplace, and the better you can then walk in, talk to those banks, get them comfortable with your model. Because if not, it's sometimes a rude awakening when we're working with startup fintechs.
Yeah, just to add real quick, Brad, in addition to those resources, regulators, especially at the federal level, and a lot of states will talk with you as well. They all have office hours or innovation departments that are willing to, and in fact, want to hear from the fintechs what the new products are, because they're trying to, as you already talked about, stay ahead of the game or at least catch up sometimes. So that's another great resource, sort of the Dutch uncle model that the regulators will help you through. And the CFPB, as another example, has no action letters, for example, to help you guide through that those landmines or potential landmines.
And I think when we're talking with fairly early stage fintech businesses, this is not the fun stuff. The fun stuff and the reason why you got into business and the reason why you're raising that capital is to get product deployed to the market and do the marketing pieces. But if money movement or lending or depository is part of part of the business model. This is the plumbing that needs to be figured out. And we were talking a little bit earlier. I mean, if you're raising $5 million of capital, don't spend all $5 million on just building out product. Save some back for regulatory compliance and building out that framework and that infrastructure that you're going to need to be able to scale.
Yeah, we capture that concept, Nathan, but it's not regulatory overhang, it's regulatory hangover. So.
Well, great. That brings us to our third topic, and you hit on it a little bit, Scott. But what does 2021 look like? And we really kind of have two paths right now that could go. You mentioned a blue wave coming, and maybe making a change that will impact us from a regulatory scrutiny standpoint, or the opposite, that they don't win, and there's continued kind of going the status quo. So, kind of give us your thoughts on what 2021 looks like, and some things we need to be thinking about when it comes to
Sure.
The regulatory compliance.
Sure, Mike. Let me sort of break it down, federal versus state. I think regardless of who wins the White House or what happens in the Senate, we're still going to see a trend towards pro-consumer, sort of anti-tech. You see some hearings coming up in the House, and there's some senators grumbling about tech and big tech, whether that's Facebook or others. Those trends, I think, will continue. If the Democrats take the White House and the Senate, or both, we could see those accelerate. We will definitely have an overhang with respect to COVID that will be around in 2021. That is affecting payments and the speed of payments. There is a move towards accelerating payments, especially delivery of stimulus money under the CARES Act, whether it's EIP or PPP money. We've seen proposals around asking the post office to get involved with payments. We've seen proposals around asking the Federal Reserve to do more with respect to payments. There's proposals around creating a central bank digital currency. So those trends will continue. We'll also see, regardless of who wins, just a matter of degree, trends towards inclusion, economic opportunities, diversity. Those trends will continue, and that will have an effect on financial services, whether that's in the form of rate caps or disproving that your product has a disparate impact. Why do the poor pay more for a bank account than the wealthy? You'll see efforts to try and close that gap, even if that means having the well-off subsidize the low and moderate income Americans from a policy standpoint. We could see that as well. So I think a lot of this will be determined if Biden wins, Vice President Biden wins, by the cabinet he selects, Treasury, CFPB, there's FDIC openings, OCC. So we'll be watching those nominations if that comes to pass very carefully. But quickly, at the state level, they're affected by a lot of the same trends. They also have the challenge of depleted coffers. So we will see a continued move towards privacy, which is a general that's been happening for a while, but also a move to increase taxes, both in terms of the rates that are charged and broadening the base. And there are a number of proposals out there that would sweep in payments companies to increase their tax liability and change the role that they play in the system. If you recall, the Supreme Court issued a ruling in Wayfair, which changed the way merchants collect sales tax. Essentially, the rub is that a merchant may be forced to collect sales tax on an out-of-state purchase, whereas previously they didn't have to. So there's a lot more sales tax revenue flowing through the system, and payments companies, given their role in payments, may have an increased role in helping to calculate, collect, or remit that. For better or for worse, we see a proposal in Massachusetts, for example, to require payments companies to remit the sales tax on a daily basis. So we obviously have a lot of problems with that approach, but that's another webinar. But those are the trends really that I see in generically, and then slightly more accelerated if we see a blue wave come in November.
And I think to Scott's point, you also can look at some of the CARES Act programs as a preview for what could happen in 2021. And so you already see, for instance, with the PPP, a broadening of the definition of discrimination in lending, where, already with PPP, demographic data, gender identity, race, ethnicities being collected, that's, kind of squares with this idea that the CFPB has been pushing of a broader definition of discrimination in order to pick up small business lending into that. I mean, I think all of that continues to grow. And if anything, this drive and adoption of digital commerce, where we're seeing a 200, 400% increase in mobile and online banking, as Scott mentioned, is really going to drive the pressure to begin regulating those services, how they're being deployed. All of us are, continue to look at things like alternative data, alternative underwriting, what have you. And the question is, what is going to be the impact of that? And I think with those innovations, whether it's faster payments, multi-purpose bank accounts, diversification of offerings, investment advisors, broker-dealers, lenders, with that is going to come increased regulatory scrutiny, because to a certain extent, I think many regulators view some of this as something of a black box. We're going to take 1,000 people, we're going to take tens of thousands of data points and decide who gets loans. And if you challenge me on it, I can tell you, well, that person had 32 social media posts Monday and they're a high credit risk. I think that's spooking regulators as we move away from those classical paradigms that are more established over the last few decades. And I think you're going to try to see a pushback for regulators to really make sure we understand that from a regulatory standpoint.
Well, and also just to build on that, Brad, I agree, is we'll also see whatever the political agenda will be, using those tools to advance the political agenda. So sometimes it's a one-to-one correlation, sometimes it's cart horse, but if you say we want to end discrimination and we see something we don't understand, then going after something they don't understand to help, politicians will often go after that as a way to leverage the policy, leverage the technology to get to the policy result that they want. So that's definitely could create an overhang or headwinds for the financial services industry.
Yeah, and especially, Scott, if we have an increasing default environment, there's ask 10 different people and you get 10 different opinions as to what the default environment looks like. Most consumer lines are somewhere around 4%, give or take, in default. There's some sleeping number of between 4 and 8%, depending on the product line, that are either operating under a payment plan or operating under some sort of alternative workout arrangement where it could be hiding inside of the numbers. And so the real number of people who are not being able to service debt as they agreed is somewhere between 4 and 12%, depending on what you look at. If all of a sudden that starts coming due, one thing we learned from the recession is when things get tight and people default, that's when regulators tighten their oversight. And so I think everybody, especially in the lending space, needs to be prepared that if we start seeing that default cycle coming through in the next quarter or even into early 2021 as this cycles through, you really need to be prepared for enhanced regulatory scrutiny. And, Nathan, you may be seeing some of that already at the bank side. Is we certainly have been seeing regulators starting to really focus on, are you prepared for defaults, and how are you going to begin servicing defaulted loan products as well?
Yeah, and I would just add that a lot of financial institutions, as part of COVID, have instituted deferments. And so some of that, what you mentioned, could be hiding, the deferments could be hiding some of the potential default risk down the line. If another stimulus package is not passed, that you could see that affect the rate, the default rate, considerably. So I agree.
Yeah, I think the other kind of cross current of PPP loans and kind of those funds essentially kind of being burned through, and kind of what that effect on the economy is going to be since those funds have been burned through. So I think we're at kind of that tipping point.
And just to follow up, if the Dems, if there's a blue wave, and they have at least a simple majority in the Senate, you will see a stimulus package, probably one of the first orders of business, in the trillions of dollars, move forward. And part of that will include the post office, most likely. So.
And I think that really could impact fintech lending because, if we're looking right now, credit has become a lot better in the last few months. But the number of people seeking access to what fintech's really good at, personal unsecured lines or small dollar instant issue credit, we've actually seen a drop off in the number of people applying for those, which is creating this odd, on the fintech lending side.
Yeah, agreed.
All right. Well, we have a few more minutes here. If you have any questions in the audience, please make sure you put them in the Slido. Anything else you guys can think of based on what we talked about today that you have as a hot topic in the regulatory world?
I guess I kind of have a question for Brad, and if he's seen any kind of additional kind of scrutiny around international payments models, given what went on with Wirecard and kind of that activity. I'd just be curious, kind of the environment you might be seeing in that world.
Yeah, I think there really is an increased focus on that. I mean, we've seen some enforcement orders come through involving banks that were doing international payments remittances. I think, too, the regulators have become much more sophisticated in that regard. And the net result of that is so many banks were getting into the payment space, playing in international, and in essence, outsourcing OFAC, BSA, and AML. And the regulators are not comfortable with that. I mean, I think you really have a renewed focus. You're seeing now much more discrete exam topics addressing that. We've both the FDIC and the OCC, and we've been working with them. It's been a great deal of time focusing on that. And I think you're also seeing them try to go down and shut down some of these banks that were sponsoring programs, or at least enter into enforcement actions with banks that were sponsoring international remittance companies. Just because when you talk about a tech-based international payment structure, probably the hardest thing, is first thing I always ask fintechs playing in that space is, how are you going to identify non-U.S. nationals? How are you going to do your OFAC screenings? Because that's the magic sauce to that. And there are very few companies that can reliably say, I can go to 100 different countries and identify the users of accounts in those countries. If you tell me you're doing that in a dozen countries, I'm prone to believe you. If you walk into my office and say I'm doing it in 120 countries, and I can tell you not only how someone in Ukraine is identified versus someone in Colombia versus somebody in Sudan. It takes a lot of sophistication and resources to be able to run that sophisticated international remittance company. And so instead, we're now seeing many more people partner with banks focusing on that space, or partnering with traditional MSBs who know that space.
Well, great. I don't believe we have any questions from the audience. Appreciate your time today, everybody. Nathan, Scott, Brad, thank you, everybody, for your participation, and enjoy the rest of the conference. Thanks.
Thanks a lot.
Everybody.